Hello and welcome to Market Domination Overtime. Stocks closing lower here with no reprieve from a building tech sell-off. Jared Blickery is over at the Wi-Fi Interactive with today's moves. Jared.
Thank you, Josh. 1 hour ago, we were looking at some modest selling, but we have seen some losses deepen into the close here. The Dow kind of matching its losses from earlier in the day, down 1.2%, or about almost 600 points there. But the selling we saw was really in the NASDAQ, and could have been worse, only down about 1.6%, but again, we're seeing more selling in the final 30 minutes, never a good sign. And the S&P 500, very similar story, down, kind of splitting the difference there, down about 1.25%. The Russell 2000 was the weakest of the day, and it is closing near the lows. So that was the most bullish looking, or coming out of January of the indices, and including some of the middle ones as well, but not today. And microcaps, throw those in there. That's down about 2 2/3%. Dow transports have been a bastion of strength this week. Not today, but on a relative basis, the least dirty shirt in the laundry basket, as you might say. In fact, that title, I think, goes to the semiconductor index. We'll take a look at those in a second. Semiconductors looking pretty decent. And while I have this here, let's take a look at the VIX, because we actually hit 20 earlier in the day, but we pulled back a little bit, but now at 20.69, we're kind of above that 20 threshold, where kind of perks up traders as they look at, well, is this more of a structural regime shift, or is this just a one-off kind of thing? Here's the large cap sector outlook, or final wrap here. Utilities, the only sector in the green, up barely 10 basis points. But here's material. That's where you find your gold and your silver trade. Those miners down 2 2/3%. Then consumer discretionary, that's Amazon, Tesla, and all those stores we love to buy stuff. That is down 2%. Tech down 1.8%. All three of those underperforming the S&P 500. And let's take a look at the NASDAQ 100. And what jumps out is the losses in Microsoft and Amazon, each of those down more than 4%. Of course, Microsoft and the software trade has been especially weak this year, even coming into late last year. But you don't really see a lot of green here in the mega caps. Meta and Broadcom, a little bit positive there. But a picture is worth 1,000 words. So let's take a look at that software. A little green in Cisco and IBM, EA, and a couple others, but a lot of dark red there that we're looking at. And then in the semiconductor sphere, a lot of green. AMD is an exception, a couple days of selling there after earnings. And I'll close out here with the Dow. You can see a lot of red, but a couple of bright spots in Procter & Gamble, Coca-Cola. So those defensive, and J&J, those defensive staples trades working out today. Josh?
All right, thank you, Jared. Let's get to some earnings now, because Amazon's fourth quarter results are just hitting the wire. You can see we're dropping initially here a quick 8%. Q4 EPS, $1.95. The street was at $1.96. It looks like Q4 net sales, I see $213.39 billion. The estimate was $211.49 billion. Q4 AWS net sales, ex-FX, up 24%. The estimate was 21%. Just to break that out, it looks like that was $35.58 billion. The street was at $34.88 billion. Q4 operating margins, 11.7%. That looks smack in line with what the street was looking for. I'm looking for Q3 North American net sales. There it is, $127.08 billion. I'm looking for consensus was $127.08 billion. Now let's spin ahead. Q1 net sales, they're guiding for between $173.5 billion and $178.5 billion. The street was at $175.54 billion. And now, of course, we want to look for that CapEx number. 2026 forecast for CapEx. Amazon is saying about $200 billion. The estimate was more like $146.1 billion. That, I think, helps explain this quick move lower, 9%. Remember, heading into this print, this stock had already been under pressure over the past 12 months. It was actually in the red. It was down about 5%. Now, some on the street had argued, including on this show, that was an opportunity, they said, because that was simply a more attractive setup into the report, that it was trading at a big discount to peers. They like what they see with AWS. Marking return to the AI game. They believe the consumer would remain resilient. That CapEx number, though, $200 billion, is going to get a lot of attention. Remember, yesterday, Alphabet certainly made headlines. They gave a CapEx forecast as much as $185 billion. So that's getting attention. Right now, heading into this print, the stock was down over the past 4 months. We're down now nearly 11% here in the after hours, despite the fact that the bullishness on the street for this name is impressive. You've got about 95% of analysts who are paid to tell you what to do with the stock who say Amazon is a buy. So remarkably bullish on the street, but at least initially here, investors have some real questions about this report and the guidance. We're here for a closer look at Amazon's results. We've got CFRA Research Senior Equity Research Analyst Arun Sundaram, as well as Futurum CEO Daniel Newman. Guys, welcome both. Let's start, Arun, with you. We got the report. We got that CapEx guide. Arun, we're talking about $200 billion. It's a number that's hard, I think, to get your head around, Arun. You got a strong buy on this name. We're down here a quick 10% in the after hours. Give me your take, Arun, your first impressions on the print and the forecast.
Yeah, thanks for having me. Yeah, no, I mean, overall, I think the one big positive here is that AWS acceleration. You know, we wanted to see acceleration. We got that last quarter. We saw further acceleration this quarter. We got 24%. I think the street was looking for around 21, 22%. So that was a big highlight there. Yeah, I think the shares are down because of that CapEx number. We were estimating around 140 billion in CapEx this year. It looks like it's going to be around 200 billion. That's much higher than our estimate, much higher than street estimates. But given what Google said last night, it shouldn't be that much of a surprise that the CapEx figure is above consensus. But yeah, 200 billion is quite a lot. I think it's about a 50% increase from 2025. And 2025 was about a 60% increase from 2024. So some significant spending ahead. But clearly, I think Amazon is still seeing more demand than it has available supply, and that's why we're seeing them, not just Amazon, but all the hyperscalers invest so aggressively to capture all this AI demand.
Dan, I want to bring in you here. Let's stick on that same thing and let's remind viewers. Amazon is calling for 2026 CapEx of about $200 billion. To Arun's point, that is far above what analysts had penciled in. Consensus was more like 146 billion. I think investors look at that, Dan, they say, okay, I want to know, I'm going to get some very strong ROI on all that spend looking ahead. Are you certain you'll get that, Dan?
I'm incredibly certain that that's coming. Look, these are very smart companies that have very good data, very good analytics, very good understanding of their demand. And basically, Josh, every CapEx estimate that's come from analysts over the last few years has underestimated what is required. Right now, Google, Microsoft, Amazon, Meta, they are all competing for the most compute. The compute is going to be the moat in terms of these companies being able to sustain their market advantages over the long term. Each of these companies understands that if they don't have enough compute, they will not be able to pivot quickly enough to the next thing. We're watching how fast new models, new services, new capabilities are hitting with AI. And of course, all of these companies are also servicing the demand of all their customers that need and want more and more compute. I saw Matt Garman this week at the Cisco AI Summit, and I listened to him talk about how the A100, that's like a 4-generation old GPU from NVIDIA, is still at 100% demand. They have not decommissioned any, and they have not seen demand go down, and they've seen the spot prices continue to go up. So the demand for this stuff remains high. These companies need it for their moats, and Amazon got it wrong in the beginning. They underspent. They understand they cannot do that again, and the street is being maybe rational in some short-term perspective of how much these companies should spend, but they're being irrational long-term if they want to see Amazon continue to do what it does and protect its moat.
So Arun, as a financial analyst then, you're looking at, all right, this call for $200 billion. What are the signs? What are the signals? What are the metrics, Arun, you're going to watch to see whether this is money that's being well spent?
Well, I mean, first and foremost, we're going to need to see AWS growth further accelerate. I think now, given that they've spent a significant amount this past year, now 200 billion in 2026, street estimates for AWS growth is probably going to increase for 2026. That's number one. Number two, we're going to look at the AWS margin line, to really see if that they're getting that ROI, and that near term there are some headwinds to margins when you're significantly ramping spending like that. But so far AWS margins have been pretty solid. I don't have it for this latest quarter, but it's been hovering around the mid 30% range, which is still pretty solid numbers. And over time, that AWS margin line could go above 40%. So we'll look to see if that how they can preserve that margin line in AWS for 2026.
Dan, I got to ask you, if I'm an investor, I'm watching this, tech pro that you are. I just heard Alphabet, all right? I just heard Sundar Pichai tell me he's going to spend as much as $185 billion. Now I got Jassy telling me about 200 billion. If I'm an investor, who downstream from this, Dan, benefits? Should I be am I looking at NVIDIA? Am I looking at Hock Tan and his crew over at Broadcom, Dan? What do you see?
Look, every part of the silicon supply chain is constrained. And right now, this should be sending signals like, right, if you want to penalize the hyperscalers for their near-term spending because you're concerned about margin pressures and you're concerned about the potential impact to their business, that's one thing. But you can tell there's some indiscriminate selling going on. Now, I think some of the semiconductors held up a little better today, but if you look at this CapEx commit, if you look at Sundar, you look at Satya, you look at Andy here, all of them are basically saying we're going to be spending big on NVIDIA. Of course, they're going to be building their own silicon, so that's great for Broadcom. I talked to Lip-Bu the other day. He and I had an agreement on the memory. We're talking 28, 29 before those constraints lift. So Sanjay Mehrotra and the team over at Micron should be feeling very optimistic, as well as the rest of the memory, ecosystem. And then, of course, you have all the other parts, the packaging, the semiconductor equipment manufacturers, TSMC. I mean, you saw their numbers in their guide. There really is no slowdown in the spending. This is definitely an indication that the market wants to hear more clarity on where the ROI is going to come from. But clearly, these companies don't care. What they care about is they do not want to be outbuilt. And Amazon, Josh, and I'll leave you here on this, but Amazon knows this better than any because Adam Selipsky's job was basically to get this right when he didn't get enough NVIDIA into AWS early enough. I think that's what ended up costing him his job. I think the fact they've been able to stand up Rainier, expand their capacity, and accelerate their growth to 24%, because they're facing 39% from Azure, 47, 48% from Google. They have to grow faster. They need more capacity. They have to spend.
Arun, you don't just have a buy on this name. You got a strong buy, my friend. You got a pound the table buy. When your clients ask you, Arun, okay, you're bulled up on this name, but what are the risks I need to think about, Arun? What were you telling them?
Yeah, I mean, the risk is really the elevated street consensus forecast. There are high forecasts here, and Amazon has to hit them every single quarter. I think Amazon also, they kind of shoot themselves in the foot a little bit because they report typically last out of all the hyperscalers. So sometimes a little bit more expectation there. But we still have a strong buy rating. Amazon. We talk a lot about AWS today, but both their retail business as well as their advertising business are both also firing on all cylinders here. And I think the best, the strong buy opinion is really predicated on Amazon's margin trajectory. Its highest margin businesses, namely its advertising business, AWS, is growing at a much faster rate than the e-commerce or retail side of the business. So that, I think, over the long term, over the next 5 to 10 years, we could see some significant operating margin expansion at Amazon. And they're close, I think within 5 to 10 years, they're going to be above $1 trillion in annual revenue as well. So that's some significant earnings potential for this company that, we still think trades at a relatively low or attractive valuation.
Dan, in the great AI trade and trend, there is this perception that Amazon is playing catch up, that it's chasing rivals, Dan, like an Alphabet. Is that perception fair, Dan, in your opinion? Is it accurate?
I think early on, and that's what I was talking about, I think they came out a little slow. They were leaning on their own infrastructure early before it was ready. They've made a ton of progress with Trainium. I think, of course, we're seeing this surging demand, and they got their NVIDIA capacity, scaled up. So they're moving in the right direction. We certainly saw a pivot in Cloud Era 1.0. Amazon, AWS was the largest by far. In Cloud Era 2, you can argue Azure and especially Google Cloud has been able to really build its own infrastructure. It's spent a decade on building capacity models, chips, and so I think they're playing catch up. But I think they're showing now the positivity of that massive base of business they had from the first compute era. As all these enterprises that rely on AWS are now starting to move to AI capabilities in AWS's cloud. This number's good. I mean, 24% from a very large base. Now, having said that, the expectations remain very high. And I will also say that Amazon is probably one of the largest potential beneficiaries of AI within their own business, and not just their cloud business, their advertising business, just like Meta takes advantage of, and of course their commerce business. They have robotics, they have physical AI at the edge, they have autonomous delivery. They have so much opportunity to pull margin out of that near $1 trillion of revenue we're going to see from them in the future, that I think that's part of the story that's being missed. And finally, for all the boomers out there that are, rotating into consumer staples and nervily moving out of tech, they've got a great play because who doesn't have Amazon delivering at their door just about every day?
Dan, Arun, so good to have both you guys on the show today. Appreciate that instant analysis, fellas. Thank you.
Thank you.
Coming up, labor market showing fresh signs of weakness. We're looking at the implications for the Federal Reserve. That's next. We're seeing a lot of labor market data today, and the picture getting more complicated. Layoffs surging to their highest levels since the financial crisis. Jobless claims jumping and jolts coming in weak. Joining me now, we got José Torres, senior economist at Interactive Brokers. José, my friend, always great to see you. And you are just the man to talk about this. Let's dig. So we did get a lot of labor market data today. Not great, José. Let's go through this. Challenger, now they track layoffs. The January report, that was the biggest amount of job cuts since 2009. Okay. Initial jobless claims, you saw that. They jumped up above expectations. Jolts miss. We had ADP this week as too. That was below consensus. What is going on here? Because the take on the labor market had been, cooling, not crashing. It was no hire, no fire. Is it no hire but some fire? Like what is the take?
Some modest firings.
Yeah.
We saw in yesterday's ADP report, you had a very non-cyclical tilt. Healthcare and education added almost all the jobs on balance. Jolts, also important to note, the lowest number since September of 2020. So we've got to go back 63 months to have a number that low. So labor vacancies down. We have an aging economy. We have immigration restriction, and that's really making it more complicated for us to see through these labor indicators and gauge where we are in the cycle. However, unemployment is still subdued. So the modest firing that we're seeing, I'm pretty confident that those folks can shuffle around and find work elsewhere. Rate cuts are going to help, Josh. Today we saw big move into treasuries, particularly the short end. First time in a while, Wall Street's now expecting a little more than 2 cuts this year, and that'll help manufacturing, construction, and small business, which those sectors have been struggling to add workers. They're going to start to be more buoyant
So
later.
you think if the Fed did cut, that would help what we're seeing in the labor market? That would address the issue?
I think absolutely would definitely bolster the numbers around 30,000 or so.
What role, if any, do you think AI could be playing here?
I think it's a limited role, but definitely having a role, particularly in the white-collar industries. We've been seeing weakness in finance. We've been seeing weakness in professional and business services. And there's this perception that a lot of the entry-level jobs, there's less positions being advertised because AI is doing a lot of that work. Now, similar to when the ATM machine came out, a lot of folks were worried about the financial workers. What happened was a lot of those tellers ended up doing other things. So I'm anticipating that AI is going to grow the labor force in other ways that right now, Josh, we can't see.
So if I was to add it up, then is the issue, just to make sure I'm framing it right, is the issue you think, Jose, on the supply side, boomers retiring, not easy to replace, and immigration policy, and on the demand side, AI? Is that the way to think about it?
Yes, and rate cuts as well. But a real positive thing, Josh, we got to remember is that the unemployment rate is really low.
But some people have pushed back on it, Jose. I have seen some folks say, yes, it's low, but I don't want to get your take on this. They'll say, but it's jumped. I think it's like a full percentage point over 3 years. They don't like that. That's a yellow flag to them.
That is absolutely true, but those historical relationships, in the past, Josh, if unemployment rate went up 50 basis points, you're in a recession. Now we're up about 110, 120 basis points, we're not in recession. Those traditional relationships are a lot different now post-COVID. Continuing claims, forget about the unemployment rate for a second, continuing claims still well-behaved, 1.85 million workers that can't replace their jobs in a labor force of around 170 million. That's nothing too crazy. I think on balance, we got to focus more on consumer spending, Josh, and productivity, because that's really what's powering corporate earnings. Labor market, we're going to continue to have these months where we have weaker data because of the whole, what you just said, the supply and demand dynamics really not supportive of 150,000 numbers. 200,000 numbers. We're going to have numbers, Josh, 50,000, 25,000. Investors now need to change the way they analyze these figures and get conditioned to 30,000 being okay.
You mentioned the consumer. In your opinion, how is the American consumer holding up right now?
I think the consumer is doing great. I'll have to mention it one more time, subdued unemployment. Capital markets still great, still a lot of gains in the past 3.5 years. Interest rates
So
coming down.
if they're healthy and resilient, Jose, then how do you explain what we hear this theme of affordability, economic anxiety? How do you square that?
There's definitely bifurcation, and there's definitely the folks at the lower and the middle end. They're starting to, actually for a while, to extend and work their way and run their debt balances higher to be able to support current consumption. So the folks they're going on the credit cards, they're not paying back their student loans. The president is taking it easy on student loans ahead of the midterm elections. So they're continuing to power through. Now the upper end is doing terrific. They're spending a lot on services, and we do have this bifurcated consumer, and the top half is doing more of the expenditures.
You mentioned the Fed. I got to get the Jose take because I don't think I've heard it yet. Trump saying, Kevin Warsh, that's my guy. That's who I want leading the Fed. What do you think about that pick? Would that have been your pick?
Yes, probably. I thought the pick.
Cautious yes.
A cautious yes, because I didn't.
Why, Jose?
Well, I like a balance. You want to have a buoyant economy, but I am more of a hawk. So I do like Kevin Warsh because traditionally.
But is that traditionally you would have thought that's the rep?
Right.
Hawkish, concerned about inflation, although now seems to be sort of moving with the data.
Yes, and there's a perception that that's what got him the job, Josh. Him coming out and saying that we need lower interest rates. On the balance sheet, the president, it's my understanding, he doesn't understand the balance sheet mechanics too well, but Warsh is essentially dovish on rates, hawkish on the balance sheet, but the balance sheet could bring problems if he's too hawkish there, meaning that he wants to trim the holdings of treasuries that the Fed has and keep that more in the private sector market's natural scheme of things. That's a hawkish thing that can drive long-term rates higher. We have been seeing a steeper curve. I thought that if he would have remained hawkish how he was in the past, I don't think President Trump would have chosen him. But the fact that he started being a little more dovish, I think that got him the job.
All right, Jose, as always, great to see you, especially on set. Thank you, sir.
Great to see you, Josh.
Time now for to watch Friday, February 6th. Another busy earnings slate for investors, hearing from names including Philip Morris, Biogen, Carlyle Group, and AutoNation, focusing in on retail. Under Armour announcing results for the third quarter before the markets open. The apparel makers coming off a tough stretch here with tariffs and softer demand still weighing on results. Analysts bracing for a mid-single-digit revenue decline in the quarter. Investors will be listening closely for updates on the company's strategy, including how it plans to reposition after its split with NBA star Stephen Curry. We're also listening to fresh commentary from the Federal Reserve with Vice Chair Philip Jefferson speaking Friday, and an insight into how the Fed is balancing cooling inflation against a still resilient economy could shape expectations for the timing and pace of rate cuts, especially after labor data delays. And finally, two more IPOs to watch for. Jennifer Garner-backed food company Once Upon a Farm slated to start trading on the NYSE, plus Blackstone-backed Liftoff Mobile is debuting on the NASDAQ, targeting a valuation north of $5 billion. These are the latest tests of investor appetite for new companies in 2026, especially with names like SpaceX and OpenAI waiting in the wings. Liftoff CEO Jeremy Bondi joins Yahoo Finance Friday to talk about that IPO. Well, that's going to do it for today's Market Domination Overtime, but don't go anywhere. On the other side of the break, it's asking for a trend.